On February 9, 2026, some of the most boring stocks on Wall Street had their worst day in years. Not a bank. Not a chipmaker. Insurance brokers. Willis Towers Watson fell 12% in a single session. Aon dropped almost 10. Gallagher, more than 9. The reason? One word: artificial intelligence. Fears that AI would finally break a business model that has quietly beaten the S&P 500 for 2 decades. Here's the counterintuitive part. These companies don't take on a dollar of insurance risk. They never pay a claim. They just stand in the middle and collect a fee on every premium, and that fee has compounded into one of the best long-run trades in the entire market. Let's get into it. Start with why these businesses are special, because once you see it you can't unsee it. When a hurricane levels a coastline, the insurance company writes the check. The broker doesn't. The broker simply placed the coverage, and keeps its commission no matter what happens next. No reserves. No underwriting losses. No actuarial guesswork blowing up the balance sheet. The broker earns a percentage of every premium, usually somewhere between 5 and 20%, and over 90% of that revenue renews year after year because clients almost never switch. It is, in effect, an annuity bolted onto the entire economy's need for insurance. The market knows it. The public brokers trade at 16 to 18 times earnings before interest and taxes, while the insurers who actually carry the risk trade at half that, 8 to 12. The reward for taking no risk is the richer valuation. That's the whole paradox of this industry. Now the genuinely clever part: brokers make money in every kind of market. When insurance prices are rising, a so-called hard market, premiums go up, and the broker's commission rises automatically on the exact same policy. Easy. But when prices fall, brokers don't collapse. They grow volume, they sell new kinds of coverage like cyber, and they charge more advisory fees as clients scramble for help. And when catastrophe strikes? The broker takes zero underwriting loss, and often wins new business from clients fleeing a disrupted market. Heads they win, tails they win. That's how Marsh McLennan just posted its 18th consecutive year of margin expansion, 18 years in a row, through 2 recessions, a pandemic, and a hard market that's now fading. But here's the tension running through this whole story. That hard market, the multi-year stretch of rising prices, is fading. Industry organic growth peaked above 11% back in 2023. By late 2025 it had slipped to around 7%. Commercial property rates actually fell 4% in the fourth quarter. The brokers, in Marshberry's words, lost the tailwind. So how do they keep growing? Acquisitions. The Big Four didn't wait, they went on the largest buying spree the industry has ever seen. In just 18 months, they spent roughly $43.6 billion swallowing rivals. The organic engine is cooling, the M&A engine just shifted into overdrive. That's the bet you're making with these stocks. Let's put the field on the board. 7 US-listed names span this business. Marsh McLennan, the giant, $27 billion in revenue, the world's largest broker. Aon, the lean number 2. Gallagher, the relentless acquisition machine. Brown & Brown, the mid-market compounder. Willis Towers Watson, the turnaround laggard. Plus 2 specialists, Ryan Specialty in the high-growth excess and surplus niche, and Erie, a fee-collecting oddity that earns over 30% return on equity with zero underwriting risk. If you've followed this run, AI networks, oil services, gold, homebuilders, and now the quiet compounders of finance, subscribe and stick around. Same depth, every industry. Now let's break down the names. Start with the giant, Marsh McLennan, ticker MMC. $27 billion in revenue makes it the largest insurance broker on earth. In 2025 it grew revenue 10%, generated a record $5 billion in free cash flow, and expanded its operating margin for the 18th straight year, a streak almost no company in financial services can match. Its strategy is scale plus diversification, insurance broking, reinsurance, and a massive consulting arm in Mercer and Oliver Wyman. In late 2024 it bought McGriff for $7.75 billion, deepening its push into the U.S. middle market. Over the last 10 years the stock compounded at roughly 15.1% a year, beating the S&P 500 by more than 3 percentage points annually. This is the blue-chip anchor of the group. Aon is the close number 2, with $17.2 billion in revenue and the leanest, most centralized model in the industry. Its big move was buying NFP in April 2024 for $13 billion, a bet to finally crack the U.S. middle market, where Aon had always been weaker than its rivals. 2025 was the integration year, organic growth of 6%, an operating margin near 34%, and 4 straight quarters of strong commercial risk growth carrying into early 2026. Aon runs what it calls Aon United, one firm, cross-selling everything from cyber to retirement. The payoff is one of the highest margins in the group. The risk is digesting a $13 billion acquisition without losing the talent that came with it. Now the roll-up king, Gallagher, ticker AJG. If you want the purest version of the acquisition flywheel, this is it. Gallagher grew revenue almost 21% in 2025, to $13.9 billion, and most of that growth came from buying other brokers. In August it closed its largest deal ever, AssuredPartners, for nearly $13.8 billion, the biggest sale of a U.S. broker to a strategic buyer in history. Here's the number that matters. Over the last 20 years, Gallagher compounded at about 14.4% a year. $1,000 invested 2 decades ago is worth more than $8,400 today. That is what a disciplined acquisition machine, buying small agencies at 8 to 12 times earnings and folding them into a global platform, does over time. Boring, relentless, and devastatingly effective. 2 more names show the spread in quality. Brown & Brown, ticker BRO, is the lean mid-market compounder, a decentralized, cost-obsessed culture that runs an industry-leading adjusted margin near 36%, with net income of $1.1 billion. In 2025 it grew revenue almost 23% and made its largest ever acquisition, buying the Accession platform for $9.8 billion. Then there's the cautionary tale. Willis Towers Watson, WTW, is the laggard. Revenue actually shrank 2% in 2025, the stock was down over 20% on the year, and over 2 decades it compounded at barely 5%, less than a third of Gallagher's rate and far below the S&P. A botched merger with Aon back in 2021 and years of restructuring left it behind. Same industry, same tailwinds, but execution is everything. Quality is not evenly distributed here. 2 specialists round out the field for very different investors. Ryan Specialty, the growth play, operates in excess and surplus lines, the corner of insurance that covers the risk standard carriers won't touch: cyber, wildfire, emerging threats. It's the fastest growing segment, and Ryan grew organically over 10% in 2025, faster than any of the giants. Then there's Erie, the strangest stock in the group. Erie isn't really a broker, it's the management company for an insurance exchange owned by its policyholders, and it collects a fixed fee of 25% of every premium the exchange writes. No underwriting risk. No long-term debt. And a return on equity consistently above 30%. The market keeps mispricing it as an insurer, it behaves like a toll booth. Now the honest column. First, and the reason for that February sell-off, artificial intelligence. The bear case is that AI erodes the broker's core advantage, its information edge, and lets clients place coverage with less hand-holding. That fear knocked up to 12% off these stocks in a single day. Second, the fading hard market. As rates soften, organic growth keeps slowing, and brokers lean harder on acquisitions to fill the gap. Third, integration risk. Gallagher is digesting $13.8 billion in AssuredPartners while Brown & Brown swallows nearly $10 billion in Accession, at the same time, with elevated debt. Fourth, the fiduciary headwind. Brokers earn interest on premiums held in transit, and Fed rate cuts shrink that income. The debate isn't whether these are great businesses. It's what AI and a soft market do to growth from here. Where does this go over the next 1 to 2 years? Base case, organic growth settles into the mid-single digits as the hard market softens, but the acquisition flywheel and stubbornly hard casualty lines keep total revenue compounding at double digits. Probable, not guaranteed. 3 things to track. 1. Organic growth rates each quarter. If they stabilize around 5 to 6%, the soft market fear is overdone. If they keep falling toward 4, the tailwind is truly gone. 2. The pace and price of acquisitions. Watch whether deal multiples stay disciplined or balloon as private equity buyers bid up every agency. 3. Any hard evidence on AI, real client defections, or just a scare? Catalysts up, a rehardening of casualty rates, falling deal prices, AI fears proving overblown. Catalysts down, a property rate collapse, a botched integration, or AI genuinely disintermediating distribution. Upstream sit the insurers who carry the risk, downstream sits every business on earth that needs coverage. Insurance brokers will never be exciting. They don't make anything, they don't take risk, and their best day is a quiet one. But for 20 years, standing in the middle and collecting a fee has quietly beaten almost everything flashier. The AI scare is the first real question mark in a long time, and how these compounders answer it is the whole story for the next 2 years. I'm Big Z, follow me, see you in the next deep dive.